It's been trending back down towards the lows of this year. Is the stock market finally cheap? I've got that perspective and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Is the stock market cheap? Is it finally cheap? We know it's just been an awful year in the stock market, awful year for investors who are diversified between stocks, bonds, U.S. international, yeah. And if you're a regular listener of the Wise Money Show and this channel, it's possible and probable things get worse before they get better. We're now back near or past, depending on the day that you're watching this, the lows that we've had for the year that were first realized in mid-June. And so does that mean the market's cheap? That, hey, maybe things will get worse, but now this could be an attractive time to get in. What's confusing about whether the market's cheap or fair valued or overvalued is you can't tell that just by looking at the actual level of the S&P 500 or the Dow. You can't look and say, well, the S&P 500 was at 4,700, it's now at 3,700 or whatever it is on the day that you're watching, and therefore stocks are cheap. No, you can't. You've got to look underneath the hood, okay? And for me, my favorite measure of determining or getting a glimpse as to whether stocks are expensive or fair valued or cheap is the forward price to earnings ratio. That's right. So the PE ratio is a ratio basically of the price of the stock compared to the profits of the company or the earnings of the company. That's PE ratio. And basically, since stocks are valued based off of their earnings and future cash flows from those earnings and all of that, what price is the stock trading at today compared to those earnings? And sometimes, if you're a student of Benjamin Graham or you study this sort of stuff, sometimes Mr. Market is very optimistic and is willing to pay a lot for those earnings of a company. And that means the price earnings ratio is really high. Other times, Mr. Market, as Benjamin Graham in The Intelligent Investor, his famous work there, says, listen, I'm pessimistic. Mr. Market is negative and won't pay a lot for those earnings. And so therefore that PE ratio is low. And the big idea is that tells us, well, are stocks expensive or cheap? And it's a far better indicator, not perfect, but better indicator than, well, what's the overall level of the stock market right now? And then I like forward price to earnings because normal price to earnings is looking in the rearview mirror. Okay, what happened back then? No, I care more about what's the projected profits. So what's that forward guidance? What are those projected profits? What's the price today compared to those future profits? Because that's actually how a stock is determined. What are those future profit expectations? And that helps derive what the price is today. So more and more companies are choosing to not give future projections, or if you've heard from Ford or heard from FedEx, and I think more to follow, they're basically starting to lower their expectations of the future. So that forward PE ratio to me is more important. Okay, so let's tune into this where we're at around September. Okay, I'm not sure when you're listening and when you're watching this, but take a look at this chart. It shows the average forward price to earnings ratio over the last 25 years, okay? And then it shows sort of one variation, one standard deviation, geek speak, stat term, but one standard deviation above that, and then one standard deviation below that. So those are those dotted lines across the middle. So average over the past 25 years, forward price to earnings is 16.85, call it 17%. You would say around that level, stocks might be fairly valued, okay? The one standard deviation above is currently at 20.21. So anything above that, you'd say, no, stocks are probably expensive. And stocks could be expensive for a while. It's not a perfect indicator that things are about to crash, but stocks are expensive. And then if you look at the lower rung there, that one standard deviation below, 13.5, anything below that, you'd argue, yeah, there's no question, stocks are cheap. So where are we today? On that far right side, you can see as of the middle of September, stocks are fairly valued. Isn't that scary, right? We've seen a big drop in the market this year, call it 20%, again, depending on when you're watching this, and stocks are fairly valued based on this chart. Now, future earnings and earnings expectations are always in flux. They're always changing. So this could change quickly. But right now, you can't necessarily say stocks are cheap. They're back to sort of average from a forward price to earnings ratio. If we stay on this chart, we've been warning here at the Wise Money Show and at Korhorn Financial Group not to, put all your chips on the stock market's going to crash. But over the past year and a half, 2 years coming out of the pandemic, stocks never got cheap when we shut the economy down. They stayed in that range of fair value, but they never got cheap. And then they got overvalued. They got expensive. The second most expensive ever compared to the tech bubble, okay? And we call it a tech bubble for a reason. Stocks were inflated. They were overvalued. And so we've been expecting some sort of pullback. You can never really fully anticipate the exact timing or what the catalyst will be, but stocks were expensive. They were overvalued, and they've come down to not necessarily cheap yet based on this metric. Let's zoom out a little bit. I think this gives us an even greater perspective. Take a look at the overall chart performance of the S&P 500 going back from before the tech bubble. Now you can see at different inflection points the value of the S&P 500 as well as that PE ratio, that forward PE ratio. And this helps us see that, listen, just because the stock market value is at a certain level doesn't necessarily mean stocks are cheap or expensive. So if you take a look back in 2000, March 23rd of 2000, the forward PE ratio was 25 times, again, the highest that we've seen on record. Well, after everything dropped and then recovered, we had in October 2007, before the great financial crisis, the stock market was back up to the same level, okay? But the PE ratio was not. The PE ratio was still manageable, okay? 15 times. And of course, we saw the crisis there, the Great Recession, the biggest downturn in the stock market since the Great Depression, not because stocks were overvalued, but because the entire financial system was on the brink, okay? If you fast forward, then we started this year at a forward price to earnings ratio over 21 times. Stocks were expensive. Today, we're at 16.4, not even as cheap, get this, not even as cheap as stocks were in October of 2007 before the great financial crisis. All right, I'm going to geek out on this one last time. Let's take a look at the style boxes, basically asset categories, stock categories within the U.S. stock market to get a greater sense. Okay, well, overall, are there some areas that are still hot and some areas that are cold, or some areas that are expensive, some areas that are cheap? And you would definitely argue small caps are on the cheaper side, specifically small cap growth on the cheaper side, and that may make sense. Harder for small companies right now with higher borrowing costs and that sort of thing to actually look appealing on our way into a recession or this economic slowdown that we're in. So small cap, specifically small growth, appears to be cheap. Small value and blend, maybe moderately cheap. But if you look at mid cap and you look at large cap, again, you wouldn't argue that's cheap. And for large growth, you might even say still sort of expensive in that it's trading above those long-term average PE ratios. So guys, my conclusion is based on this data. Objectively, it's possible stocks aren't cheap yet, okay? Still. So brace yourself that if we do head into a recession or are already in one and things get worse before they get better as the Fed is marching towards taming inflation and so that we can get on the other side of it, stocks could get worse before they get better. Things could actually get cheap before they get better. How the stock market works, it doesn't go from, oh, things were overvalued, now I'll just bring things back to normal. Normally it's a pendulum that swings, okay? So overvalued to cheap. It's not going to just come back to average and just say, okay, now everything's fine. No, normally it's a pendulum that swings back and forth. But there is some good news. If stocks aren't cheap yet, Does that mean you need to abandon your long-term investment principles, abandon your current strategies, put more in cash, something like that? I would argue no as well. You've got to work with your certified financial planner. Make sure that you are not taking too much risk. Make sure you've got the right strategies. Make sure your investment structure is all connected to your overall financial plan, what you need those dollars to do. But if you take a look at this chart here, these two charts that actually show from a historical perspective, when the PE has been at these levels in the past, what has that meant for future stock market returns? And for the 1 year return, that's a leaf in a hurricane. You can't predict, based on today's PE, you can't predict where the stock market is going to be a year from now. The only clustering, so that orange line shows there's no correlation, there's no connection here. R squared is terrible, all right? But there is a lot of clustering around that middle that when PEs appear to be in this range, 10, 20% forward return, so that's a return over the next year, is possible and probable, okay? But the 1 year, I'm going to say, is sort of irrelevant. It's just completely random. The 5 year return, though, is we have got a little bit more confidence in. That's not a high R squared, but that's better. You can see there's some connection correlation there. And so if you look at that line, based on today's PE, we could expect that over the next 5 years, the stock market would average an 8 to 10% rate of return. Very possible that it doesn't. It could average a 0% rate of return, as you can see that clustering around the 0% line. But this is giving us much more favorable future market returns compared to that 5 year chart when it was at 21. It meant, and we've been sharing this with clients, it's very possible 5 years from now that we still are back at the same levels of the S&P 500. So if I could give you some optimism, although stocks don't appear to be cheap yet, they're no longer expensive. And at these levels, our forward return expectations are much better than where they were at the beginning of the year. So hopefully giving us some indication that things should recover as we get past this. Historically, that suggests that we should. So work with your certified financial planner. Make sure you're taking the right level of risk in your investments, you're using the right strategies, and all of that is connected to your overall financial plan, your comprehensive financial plan of what you need those dollars to be doing for you. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.